what do we expect to see in the primary market? And I think, in the primary market and really with all of this, I think as go tariffs, so go the market. This is Open Work, a look inside the watch industry, a podcast from Collective Horology. I'm Gabe Riley, co-founder of Collective.
And I'm Asher Rapkin, co-founder of Collective. Collective Horology is an independent watch retailer based in Southern California. We carry a wide range of independent brands, including Ming, Fears, J.N. Shapiro, and more. To learn more about us and check out our available inventory, visit collectivehorology.com.
Speaking of inventory, it is time for a market update. So today we're going to take a look at the current state of the watch industry. We're halfway through 2025, and it has turned out to be a very eventful year, to say the least. And that very much shows up in the data for the watch market. So today we're going to look at all the data sources we can muster to understand just how the watch industry is faring at the midway point of 2025 and where it might be heading next. And when we say look at the data, we've done a couple of these things in the past. We had our good friend Hamza Masood on a couple of times in the past to talk about the watch market. And of course, Hamza is from Watch Charts, and Watch Charts very much focuses on the secondary market, which is fantastic. The data is amazing. And that data tells us a lot about what's going on in the primary market and sort of the watch world and industry overall. But this time, I think what we wanted to do, and we should have Hamza back on to talk specifically about the secondary market. But this time, what we wanted to do halfway through the year is take a more holistic look at the state of the industry. So Watch Charts, of course, remains a valuable source for us. But we're going to look across a wide range of data sources, whether that's export data from Switzerland, other sources on the secondary market, other analyst reports and things like that, annual and quarterly earnings reports from the holding companies and other publicly traded companies in the industry, to give a much more holistic sense of where things are. As always, all those data sources are going to be available for you guys to check out. So if you're curious about where we're getting this information from, or you want to see kind of the full context on whatever it is we share, that's going to be at collectivehorology.com/blog, and you can check out all of the data sources there. So, Asher, when it comes to 2025, and it's hard to believe we're only 6 months into the year, it has been an eventful year. I think the place for us to start is probably on just to kind of set the broader landscape in terms of like what's going on in the broader kind of economy and what is the backdrop against which the watch industry is sitting right now and where things stand. So what do you think? Should we start with kind of an overall look at the market and then dive into the specifics? And when I say dive into the specifics, we're going to take a look at kind of the overall state of the watch market, how sales and exports are going to go. We're going to take a look at regional highlights in the US and North America, Europe and the UK and Asia. We're going to look at secondary market performance specifically. There's some interesting highlights there. We're going to look at certified pre-owned. We've talked a bunch about the growing importance of certified pre-owned programs and the role that they play in the market. We'll look at that. And then we'll just sort of give a broader outlook on what we think is worth looking at as the rest of the year unfolds. But in order for us to do that, probably makes sense rather to start with the bigger market and what exactly the backdrop was for the first half of the year.
Yeah, so I don't think it's news to anybody that probably the biggest economic news as it relates to the watch industry happened in April 2025, right in the middle of Watches and Wonders, which was, of course, the so-called Liberation Day tariffs, which were imposed by the United States on essentially every country in the world and essentially every good manufactured in those countries and imported into the United States. The original reciprocal tariff rate was set at 31% for Switzerland and was subsequently dropped on April 10th to 10% for a 90-day period. So we're actually coming up right now within a few weeks of when that 90-day pause will be lifted. And I think when you zoom out, that's actually a pretty good metaphor for the reality of the reality of the economics of import into the United States right now, which is that it's very much up in the air. And that is exemplified in what was essentially a bum rush to get goods into the United States prior to the application of those tariffs, followed by a sharp decline immediately after. Gabe pulled some of these numbers. It looked like the Swiss exports into the U.S. Immediately prior to the application of these tariffs is around 852 million CHFs. That's coming up on almost, I believe, over $1 billion. That's up 149% year over year, followed by a sharp 25% decline in May, once it looked like the baseline 10% tariff was here to stay. Clearly, we don't really know where this is going to go. Here in the United States, the Court of International Trade has ruled that the application of these tariffs was illegal. But of course, that case is moving its way through the courts right now. So if we zoom out, that uncertainty is certainly having an impact on our industry and the macro economy as a whole.
Yeah, and in terms of the macro economy, and look, we are not experts in the macro economy, but I think anyone listening can certainly get the sense that the question around the broader economy is a bit uncertain. So one thing that we've seen in the past has closely correlated, whether it's a coincidence or it's causal or not, with watch sales has been equity market performance. So this year, just in April alone, the S&P 500 in the US here fell 10%, and it's since recovered. But for the year, at one point, the market entered near correction territory. I think it was like 19.6% down on the year in April, and it's mostly recovered, I believe, at this point. I'm not an expert on this stuff.
Yeah, I took a look. Well, it has mostly recovered, but that's only if you're looking at the DGIA, the Dow Jones.
Yeah, I'm talking about the S&P, which kind of correlates with the Dow Jones and all that stuff. But let's just say, like, whether it's the Dow Jones Industrial Average, the S&P 500, global stock market indices, there's been a lot of volatility. And again, we're not analysts here, we're not experts in this stuff, but it points to some economic choppiness that's going on in the broader world economy. And of course, that impacts consumer sentiment as well, and how people feel about discretionary income and spending money and the wealth effect or lack thereof and all that kind of stuff. So it's been choppy waters, let's just say, in the broader global economy. Tariffs have obviously been a part of that, but many current events have been a part of that. And then it's funny, in our own survey, and we did a whole episode on our sort of winter 2025 collective voice survey, where we surveyed folks listening, clients, and people, more broadly in the watch community about where they see the watch industry right now, how they're thinking about watch purchases and watch collecting more broadly. And we talked about this. We don't need to rehash the details, but what we heard loud and clear from enthusiasts and collectors and clients was they're becoming more discerning in what they're buying, how they're buying, and how much they're buying. And I think that reflects this broader economic backdrop of a lot of volatility, and watch collectors in particular just becoming more discerning and more thoughtful in how they're approaching the hobby and their purchases. So that's kind of the backdrop of the world we're in. And I think it's important to paint that picture, because it's going to put a lot of the numbers we share next into pretty stark context and help paint that picture. So before we get into regional specifics, we talked about tariffs in the United States. Let's just take a look more globally at exports from Switzerland this year. And Asher, when we talk about the global market and exports globally from Switzerland, you've wisely pointed this out. There is a difference between what's exported from Switzerland and presumably sold into distributors, sold in regionally across the holding companies, and sold to dealers, versus what's actually purchased from a retailer or a brand boutique or whatever by an actual customer. So these are very much wholesale figures, but they certainly paint a picture in terms of how Switzerland is relating to the rest of the world and the pace of the export of watches from Switzerland. So you talked about this in particular around April and May, where there was a spike and then a huge drop. But I think it's worth taking a look at exports of watches from Switzerland in January through March, before all of this happened, before tariffs were ever really a twinkle in anyone's eyes.
Tariffs were a twinkle in someone's eye?
Well, I don't know. So someone's eye they were. Surely someone had that twinkle in their eye. But in January, the exports from Switzerland got off to a really strong start. So in Swiss francs, we saw 379 million Swiss francs worth of watches exported in January. That was up 16% year over year. So in other words, in January of this year, January of 2025, the value of watches exported from Switzerland compared to the previous January was up 16.2%. So that's strong. That's a sign of the industry recovering. And obviously there's some seasonality in that, but I don't think January is generally a particularly strong month for exports. The first quarter of the year is generally for the industry overall relatively slow. So the fact that you see that strong of an uptick at the beginning of the year is a good sign. Fast forward to May, March rather, a couple of months later, right before the Watches and Wonders and tariffs, similar story. Exports out of Switzerland were up to over 400 million Swiss francs, so 405 million Swiss francs. And again, that was up 13.7% year over year, so compared to the previous March. So in the first quarter of the year, exports out of Switzerland were really strong. And then, Asher, I'm going to give you the pleasure of again painting that picture of what happened in April and May, and we can talk about kind of what we're seeing here, looking back at the first half of the year in terms of the pace of exports from Switzerland.
Yeah, I mean it's what we said. April we saw a whopping 852 million of Swiss francs of imports, so essentially over $1 billion of import, up over 150% year over year, leading into a stark decline in May of 268.2 million CHF, which is a negative 25% decline. But I think we need to look at that contextually. My assumption there is that there was so much front loading of inventory that there had to be a dramatic drop off in May because they shipped the majority of it that they had probably intended to send over the course of the year in one month period, as opposed to what was coming in May. So I don't know that the rapid increase and the sharp decline is doing anything other than demonstrating a rebalancing of inventory from one country to another, which is what I suspect was going on here.
I think we kind of know that's what's going on here. We spoke to a number of brands and brand leaders at Watches and Wonders when all the tariffs were announced, and they were like, we are going to get everything we can to the U.S. as quickly as possible. And when you do that, it becomes hard to lap those numbers the next.
Yeah, and it also indicates I think a truism that is happening across so many businesses globally right now, which is a desire to create as little economic turmoil and pricing turmoil as possible by trying to preserve as much runway as possible while the powers that be determine both the legality and the longevity of these tariffs. We certainly are seeing this in other industries as well. And I think it's important to note, too, that like a lot of businesses, whether it's the watch business, whether it's, the banana industry, the coffee industry, lots of industries that do not have any form of footprint or are unable to operate in the United States are working really, really hard to absorb a lot of these costs. And it's causing a lot of hidden challenges that consumers aren't seeing. So this first 6 months of data that we're looking at right now is essentially the prepper stage, if you will. And I think there's probably more to come in the back half of the year that will really, demonstrate whether this was something that we were able to get through, whether the legality of these tariffs was decided, and they're ruled illegal and therefore some of these losses are amortized, or if this is the new reality of import into the United States and the economy will rebalance itself around higher prices, price inflation, and more challenging import. So I think the short answer is, as we said earlier, like we just don't know. And that's why you're seeing such erratic numbers playing out.
Yeah, exactly. And again, these are wholesale numbers. So what you see here is basically the Swiss watch industry. And again, we've talked about this. Obviously, these are global numbers. But when you look at April, it's pretty clear that the U.S. was driving the gain in that month in particular. We'll talk about some regional numbers in a second. And when you consider the regional numbers overall in terms of what's happening in North America versus the rest of the world, these numbers very much reflect, one, in the first quarter of the year, so January through March, the strength of the North American market. You see the brands loading up the market, presuming that it's going to be a good first half, a good year, and getting inventory into the markets to meet the demand they're expecting. And then again, as you say, April represents kind of the prepper month, and the industry working to do everything they can to mitigate passing on costs to the consumer. So look, I think we can say the year got off in the US in particular. We'll talk about those numbers next, to a strong start. And then now we're in a little bit of a holding pattern until we see kind of where tariffs end up and how that plays out. So let's talk about those regional numbers in particular. So we're going to talk about the United States, Europe, and the UK, and then what's going on in the Asia market. And if we don't have numbers for other markets around the world, like, so for instance, there's just not anything here on Latin America, it's because we just don't have access, at least Collective doesn't have access to publicly available data about that stuff. It's not because we want to exclude those markets. So this is data that's available to us that we can use. And I think in the United States, we've talked about it. The story is clear. The market was loaded up in the first half, one, on the back of the strength of the market initially, and then two, to prepare for tariffs. But the United States has been a bright spot for the Swiss watch industry, both the mainstream brands and the independents, for the last couple of years. The rest of the world has really been challenged and seen sales declines, while the U.S. has actually been not just gaining share in terms of the total number of exports, but also the sales volume and the value of watches sold in the United States has continued to go up. So we'll see what happens there. But Europe, interestingly enough, in the first half of the year has seen some stability. So it's a market that in the previous 2 years had been in decline, at least in terms of wholesale, and that's a market that has seen stability. It's obviously shielded from a lot of the tariff issues we're talking about, but it continues to perform stably, generally speaking, on a year-over-year basis. Value of watches sold in Europe has held firm,
and I think you're there's a point that you put here in the notes, I think is pretty critical, which is part of the reason why it's probably performing so well there, is that that is a European product produced within the not within the European Union, but produced within Europe with a free trade agreement between Switzerland and the rest of the EU. So, it's somewhat shielded, so to speak, from the rough waters of the American economy at the moment, from an import and export basis. However, Europe, of course, is not immune from the impact of American economic choices. So I think it's actually kind of interesting to see that European demand remains stable. I would have imagined that there would have been a little bit more volatility there, but that's a good thing.
Yeah, it's interesting. When I look more closely at the numbers for Europe, we talked about them being shielded from tariffs, kind of, sort of, but not really in a way, because it's interesting when I dig into the numbers, that they're relatively flat on the half. But when you look at May, exports from Switzerland to the UK were down 14.5% year over year. To France, down 18%. To Germany, down 4%. And I think that can... And again, that also reflected there was likewise a strong April. Exports weren't up 150%, but they were up 18%. And so I guess it points out that, like, we're in a global economy, in a global watch market, and things like consumer sentiment don't just happen in a market like the United States and nowhere else, but globally, consumer sentiment is, if not correlated, it's interrelated. And so there's volatility in not just in the United States, but in Europe as well. And there was some softness in terms of exports from Switzerland to those key markets in May. So they're shielded to some extent, but not fully, which is interesting. The story, however, in Asia is really quite different. And we are far from experts, obviously, in any market really outside of the US where we operate, but certainly in Asia, which is a giant landscape geographically, a ton of diversity of economies and countries and cultures. But suffice it to say, Asia continues to be a relatively slow market.
Yeah. I don't know enough about the Asian market to make an analysis on that, but I think what is remarkable, and I think this is probably general common knowledge, is China in particular, and Hong Kong too, are dramatically important to the watch industry and have been historically. Hong Kong in particular, the volume of watch sales in just within the SAR is astonishing. And, that revenue has to come from somewhere else when you roll it up into a global P&L for a brand to still feel resilient. So, I think there's probably a lot to come to here in terms of how some of these brands are going to start moving pieces around on the chessboard, both to optimize their own profitability and also to make sure that sell-through happens. Watch companies are, of course, businesses, and this is something that they are going to think about really hard. And it's interesting, in our conversations with some brands have looked at the United States and said, U.S. actually isn't our dominant market. So we're just gonna pull back a little bit, and we're going to try to put some more energy and a little bit more powder behind more effective markets. Larger brands don't have that luxury. When you look at a Rolex or a Patek, for example, the United States is such a dramatic component of their overall revenue that they can't just reallocate watches to another market. And I think that from a business strategy standpoint is going to be a really interesting thing to evaluate over time.
Yeah, just to give that some context in terms of numbers, like how exactly the market in Asia is performing overall. And obviously, you mentioned China and Hong Kong; those are the two of the largest watch markets in the world. Sometimes either one of them can be the number one watch market in the world. We've talked about how in the last couple of years, the United States has overtaken those markets to be the number one market for watches. And that does to some extent reflect the strength of the US, but more so challenges that are happening in China and in Hong Kong, some economic issues that are painting that backdrop there. But I'm just going to give you some numbers here. So January of this year, exports to China from Switzerland, so Swiss watch exports were down 29%. Okay. And then in April, and I don't have data for every single month here. It's not published every single month by the FHS. It's reported on sort of intermittently, but then we go to April, down 30%. So quite similar, 31%. And in May, down 17.4%. So it's a market, when you compare that to, say, the United States, which has been very strong in the first half of the year, Europe, which has been relatively stable in the first half of the year, China continues to show decline after decline after decline in terms of the value of exports. And you may remember some of the numbers we shared around exports to the US. I'm going to give you those export values to China. So in January, 138 million Swiss francs. For instance, in the US, in January, it was 379 million. Now, think about the fact that China was once the larger market than the US. This is a market whose performance has fallen for whatever reason quite dramatically. And this has a major impact on the Swiss watch industry.
China is a country that's 5 times bigger than the United States by population. There's 1.4 some odd billion people that live in China and about 360 million that live in the United States. So if you amortize that per capita, it's way lower.
That's a great point. And I think this points out, like, we need to do an episode on, we've talked about the watch industry from a manufacturing standpoint in China. We need to talk about kind of the watch and luxury industry in China from a consumer standpoint, because I am sure it's fascinating. And we would learn a ton, and it obviously has massive implications for the watch industry. So future show topic noted. Let's talk a little bit about the pre-owned market. We've talked about new watches here. Let's talk about what's going on in the secondary market.
All right. So a couple of points just to look at here. So Rolex continues to be a well-run company that is always tweaking the edges. So we're looking at 0.4% quarter-over-quarter growth from a secondary market standpoint, slightly down year over year, just a little bit shy, but under 1 point, so 0.8% year over year. And I think most notably, more than half, just a little bit more than half, 53% of Rolex modern models are selling for a little bit above retail. So once again, Rolex continues to demonstrate very strong brand strategy. Patek Philippe is slipping a little. We're down about 1.5% quarter over quarter. And so that's about 3 times as much decline as what we're seeing from Rolex. Unsurprisingly, the Nautilus and the Aquanaut remain relatively resilient. And we're starting to see that same erosion with Audemars Piguet, with about 0.3% quarter over quarter decline. Most Royal Oak models are holding stable. I mean, Audemars Piguet basically, eats their dinner with off the Royal Oak. Everything else they make is nominal relative to the revenue produced by that one family of watches. But again, if you take a step back and you look at this compared to what we've seen over the last couple of years, this is relatively stable.
It is, and I just want to shout out something that Hamza published in Quill and Pad, because I think it's important to the point you're making here, which is overall what we're seeing in the secondary market is finally some stability. What we've been talking about for the last year or more,
3 years with
the secondary market. It is like, on this podcast,
2 years.
But what we've been talking about for the last year on this podcast is this notion that, it sometimes for people, it feels like buying a watch on the secondary market feels like catching a falling knife. We're just watching secondary market valuations go down and down and down. And when you look at the secondary market overall, and Hamza talked about this with us on our last 2 podcasts on this topic, the price in the secondary market showed no sign of stabilizing.
Well, it does depend on the brand, right? So like when we look a little bit,
that's where I'm getting. That's where I'm getting to. So the reason why is Rolex, AP, and Patek, which you've just pointed out, are the big 3 in the secondary market. They're not just the top 3 brands, but they comprise over 50% and probably more of the value of transactions happening on the secondary market. When you take those brands away and you look at the rest of the secondary market, and this is what Hamza published just a couple of weeks ago in Quill and Pad, and I would recommend anyone take a look at Quill and Pad for Hamza's June 2025 market update. He shows, and the data from Watch Charts shows that aside from Rolex, Patek, and AP, basically everyone else is in decline, with the exception of maybe Tudor. And it's really interesting. The other brands continue essentially to be in free fall. Even brands we think of as hot brands. We've talked about this in the past. Cartier. Cartier is a brand that is very much in the zeitgeist, is very much top of mind. Their novelties get a lot of attention. They seem to be desirable on the pre-owned, or at least certainly the vintage market, but the secondary values continue to fall and fall and fall. So overall, we're seeing stability, but Asher, you're absolutely right. When you look at the brand level, most brands are continuing to see their values on the secondary market decline.
Yeah, I think part of this too is also, and I don't want to go off track, but the data I think does correlate with this point, which is I think some of the brands that are seeing the worst resale slides are the ones that are the most, I'd say, out of touch with their pricing on the primary market. So if we go from worst to modest, we have Hublot as the worst with a negative 5.2% quarter-over-quarter change. Hublot has always been a watch brand that prices themselves at what they want you to pay, not necessarily what the watch is worth. And I think folks who know me or have listened to me talk know how much I actually love Hublot as a brand. So this is not me ripping on them from a product standpoint. I think they actually are some of the most creative folks in the market. But I've often described Hublot's pricing strategy as a game of horological chicken, daring people to pay what they're asking for something that is objectively really cool, but questionable if it's actually competitively priced. And that's what we're seeing here in the retail market. It's not that people don't want them. They just don't want to pay the retail price for them. And I think that applies also to Tag Heuer, another brand that I really have a lot of respect for. But I think Tag Heuer comes at it from a slightly different perspective. And my guess is what we're seeing there is Tag has always been a high volume production or high production volume company. And when you're a high production volume company, you're going to be very exposed on economic changes. So if there's a pullback, especially at the price points that most Tag Heuers sit at, you're going to see a slide in value retention because there's just so many pieces in the market, and it's very difficult to pull those back or put them back in the way that say Rolex has extreme control over their distribution. So I think when we look at those two performers, both of them, it's interesting, two things to note. One, they're both LVMH brands. So that's going to roll all the way up to the results for LVMH's watch division. And two, it also indicates some of the exposure that brands have when they are high production or when they are ambitiously priced.
Speaking of ambitiously priced, I want to talk about CPO. And this isn't just Rolex CPO, but this is the world of certified pre-owned programs in particular, because they represent this kind of new corner of the pre-owned market, or in many ways for a much more casual consumer, an entirely new market. I mean, for a lot of people, CPO programs and the Rolex program in particular is opening up a new channel of availability of watches that just didn't exist to them before because they're not buying watches the way enthusiasts do. The fact is, it is a juggernaut of a program right now. So as of the first half of this year, there are now 214 locations that have a Rolex CPO program, and it represents 104 partners. And so what's interesting about this is if you think about the partners with whom Rolex started the CPO program, it was Bucherer, it was Watches of Switzerland. In the United States, it was, I believe, the 1916 company was one of the early partners in this market. These were major retailers with multiple points, dozens of points in some cases, like Bucherer, the largest retailer of watches in the world. Watches of Switzerland, the largest publicly traded retailer of watches in the world. So now there are 214 locations, but 104 partners. What this means is the program is being rolled out to the Rolex dealer in your backyard, the family-owned and operated business who's been there for generations or whatever the story might be. This is no longer just the domain of the large players. And what that tells me is this is obviously not just a program that is gathering steam. It is a program that is here to stay and is essential to Rolex's retail strategy. It's not a test with a handful of partners. It is now being rolled out across markets with retailers of every size, every shape, and every form, which I think is really interesting. So Rolex doesn't report their data publicly. Watch Charts does try to. One thing that's interesting about the Rolex CPO program is, unlike other Rolex inventory, the dealers will often publish their inventory, or they typically publish their inventory online, both on their websites, but they'll also publish it via Google Shopping and other sources. So Rolex, the CPO program, is able to be scraped. In other words, we have a sense of what's out there and what the asking prices are, and in some cases, what's churning. And it's a program that is moving. So Watch Charts in April basically estimated that there's about 170 million of inventory for Rolex CPO and about 100 million in sales. So if you think about that, that's a 60% turnover. So there's a significant amount of inventory that's out there that Watch Charts is tracking. And if you have 170 million in inventory and 100 million is actually moving and selling, that's a pretty good sales pace. And I know among enthusiasts, there was a lot of skepticism about the CPO program because when you're a watch expert, when you're someone who really knows their stuff and knows how to buy on the secondary market, or even imagine that buys on the forums and from those sort of trusted dealers in the Rolex pre-owned market, it's hard to swallow what can be a 30 to 35% price premium for a Rolex CPO model. So what I mean by that is, let's say a trusted dealer on the secondary market lists a Submariner of a particular reference number, condition, particular year, whatever it would be. And that same watch is then listed by a Rolex CPO dealer. That same watch listed by the Rolex CPO dealer is going to, the price on that is going to be 30 to 35% higher. And so for a lot of us, we looked at that and we're like, who's going to pay these prices? Rolex prices on the secondary market are high enough, but the sales velocity suggests that people are buying these. The rollout of that program to 104 different separately owned and operated retail partners suggests that this is a program that is not just here to stay, not just essential to Rolex's business, but is actually selling and transacting.
Yeah, what I'd love to do as well is at some point do a comparison of the operational structures of various different CPO programs. And the reason why I point that out, I believe most CPO programs, including Rolex, the authorized dealer is buying the watch and the authorized dealer is selling the watch and setting the price of the watch. And while Rolex is, obviously being paid to service it, for example, I wonder how profitable that fundamentally is. So like the CPO program isn't actually making a lot of money for Rolex. In many ways, it's kind of a service for the dealer. So when we look at like that 30 to 35% premium, there's two words for that. It's a premium or it's a margin, because the other way to look at it too is like part of the reason why these watches are so much more expensive. Sure, it's that they're serviced and they come with an extra 2-year warranty, totally. But I mean, let's be honest. If you buy a watch from a really great online trusted dealer, it effectively comes with basically the same level of warranty. If something's wonky with it, they'll fix it for you. So really, you're buying a degree of confidence, and you're paying that authorized dealer for giving you that confidence. So it's a revenue generator for the dealer. I'm not really positive it's a revenue generator for Rolex, though it is a goodwill generator potentially. Now, what I would be curious to know is if there are other CPO programs where the brand is acquiring the inventory. In other words, the brand is buying the watches and then they're wholesaling the pre-owned watch to the dealer, in which case the margin is and essentially the selling price is set by the brand. So I don't know if the selling price were set by Rolex, there would be some pretty significant secondary market manipulation at play here, but they're not set by the market, essentially. So I think there's a lot to uncover as we start to look at a growing 100 million, potentially at some point billion-dollar business. If you add up all of the CPO programs separate from the secondary market and analyze them, I'd be really interested to look at process and profitability and the rest. So yeah, 214 locations, but Rolex themselves, I doubt they're making 100 million at all on this, just in service costs. And I don't know what the profitability is on that.
Well, they're doing what Rolex does well. You open the section talking about the fact that Rolex is a well-run business and one that has a very long-term view. And so protecting the value of their watches on the secondary market, yes, it may not be a profit center. I doubt it is, like you're saying, but it does protect or even enhance the value of the brand long term.
Oh, 100%. 100%. I think there's great goodwill there.
But Rolex is Rolex, as you said before about them. They are a quote case study of one. I think, the final note on the CPO thing is like when you look at the success of Rolex, when you look at the fact that it is rolling out so well across markets, across dealers of all sizes, and when you see the sales, not just the volume, but the pace of sales, you start to wonder, and you also read about other brands investigating similar programs. So there are a handful of brands who have either started to pilot their programs or who are considering these kinds of programs. It remains to be seen, to your point, one, what business model they have there. Are they all willing to do what Rolex does? I mean, we know Rolex is a very long-term business in its nature. The other large holding companies, or the large holding companies, whether it's Swatch Group, Richemont, or LVMH, tend not to be as long-term in their thinking. Are they going to set up the same kind of program, and will it even work as well? I mean, of course, a big part of what drives the success of Rolex's CPO program is the strong value retention of their watch.
Well, I think Rolex probably thinks about it not just on a long-term horizon, but as a brand initiative, whereas I would suspect an LVMH or Richemont would look at it as a profit center.
A sales initiative. A sales initiative or a profit initiative. And so I think when you look at the success of the Rolex program and you start to assume like, well, now every brand is going to do this because it's worked so well for Rolex, and obviously there are analogs in other industries like the car industry, I don't know if we will see it roll out quite so broadly or be as successful as quickly as it has been with Rolex, but who knows? I think all of this is to say the certified pre-owned segment of the pre-owned watch market, or the secondary watch market, is an important one. It's a growing one. It's here to stay, and it is certainly one to watch. So we will keep our eyes on the pre-owned and the CPO programs going forward.
Shall we look to the future?
Speaking of that, let's look to the future. So I think what we can do is just say kind of like, what are we expecting? We've talked about the primary, the secondary, CPO. There's a few other things to talk about, but what do we expect to see in the primary market? And I think, in the primary market, and really with all of this, I think as go tariffs, so go the market.
Yeah. So when we look at the overall expectations, there is an expected decline of 6 to 9% year over year.
Yeah. And look, that 6 to 9% year over year decline for the year is from Morgan Stanley's 2025 Q1 analyst report on the industry, right? And so one, That report was published at a particular moment in time. Let's remember what it was like in the first few weeks of April, not just for the watch industry, but for the economy overall. The sentiment was at a low, as you mentioned. The market just within April was down 10%, about nearly 20% on the year. So look, who knows if that forecast would stand if it were still made today. We'll see what Morgan Stanley's next analyst report says. But I think it's suffice it to say, whatever happens in the watch market, both in the US but globally, as we saw with the export data, whatever happens with tariffs is really going to determine the primary market overall. I think there's an exception within that. And when we talk about the primary market overall, we're talking the big brands, the big holding companies. I do think independence has been a bright spot in the market. Obviously, the data on independence is harder to track. But when we look at media reporting, and in particular, when we look at our collective voice survey, what we see is a disproportionate amount of interest or interest shifting from established brands who are going to bear the brunt of any economic volatility that is happening because of their scale and because of generally speaking, the clients to whom they appeal. It's a much broader audience. Versus the independents, there's much more, at least among our audience and people who are enthusiasts about watches, there is, I think, a sea change and a shift in growing interest toward the independents. And so in a market that is very choppy overall, I think independents remain a bright spot. I often talk about them the way the analogy I give for independents in the watch market overall is that of, and this doesn't hold true, I don't think anymore, but it's like, think about craft beer. For decades, in the United States in particular, I don't know how beer sales were doing in the rest of the world, but in general in the United States, mass market beer was in terminal decline, probably still is. But craft beer was a bright spot. So it was not just growing share in a shrinking market, but it was growing in a shrinking market overall. And I think that is what we see with independent watchmaking. It continues to be a source of interest, but also from a sales standpoint, from what we're seeing and what we're hearing from the brands we work with and our other colleagues in the independent watch industry, it is a bright spot in the industry and it is not facing a lot of the challenges that the bigger brands are seeing. So I hope, and I think we'll see, regardless of what happens in the broader watch market, strength for independence.
I mean, look, I think also, obviously, it's important for us to identify our own bias in that scenario. And, we only sell independents at Collective. So obviously, we're biased towards them. But I think the other data point is our own sales data. And we're just seeing what is growing year over year. And we're also seeing what people are willing to trade. So, look, when we zoom out here as we wrap this up, 2025 is a year full of, so far, pretty unexpected twists and turns. What we are seeing, though, if we want to look at this and think about it more positively, is a heck of a lot of resilience, frankly. And, I think a lot of that is driven by the other side of the coin of uncertainty. Uncertainty, it cuts both ways. There's the what happens if everything, goes pear-shaped. And then there's the other side of it, which is, but what if it doesn't? And I do think that those two things are in some degree of equilibrium at this moment. We will revisit this in 3 to 4 weeks once July 10th passes and we're past the 90-day mark on the pause on reciprocal tariffs and see what happens there, because I really feel like that's the way.
Are you saying we're going to need to do another special episode on tariffs, Asher? Did you just call that?
I hope we won't have to, because I hope that we'll be on more stable ground. But if we aren't, then we will revisit it.
Yeah, and I think exactly that's the bottom line. There's a lot to talk about when it comes to what's going to happen with the market. From what is the future of CPO programs? What is the future of all of that inventory that the brands brought onshore in April, for instance? And I think the big question, the answer to that question, because you're right, it could go any number of ways. I think the big answer to those questions are, as go tariffs, so goes the market. And that's not just the watch market. That is consumer confidence. That is almost every market imaginable, and it's not just in the U.S. Like we said, the things that are happening here, for better or worse, we apologize to our friends abroad. The things that happen here and in this economy do tend to have implications for other markets. We saw that in the export data. So we'll see. Depending on how all those things go, you'll certainly hear from us about tariffs in the future. Asher, do you think we've talked enough about the watch market?
Yes.
All right. Well, we will leave it there. This, of course, is Open Work. It is a production of Collective Horology. You can find us online at collectivehorology.com. And to get in touch with your questions, your thoughts, your feedback, your ideas for future show topics, or your own market calls, just email podcast@collectivehorology.com.